Welcome to an introduction to managerial accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com. In this podcast, we shall take a further look at cost-volume profit analysis, including the calculations for break-even points, margin of safety, and contribution margins. We start by considering what we mean by profit. Profit is the difference between the total of the sales revenue less the total of the costs. In our first podcast, we determined this profit to be the selling price less the variable costs and the fixed costs. Thus, for any number of units, the profit will be equal to the selling price multiplied by the number of units, less the variable costs multiplied by the number of units, and then less the fixed costs. This is usually referred to as the profit equation. An important calculation for all businesses is to determine the break-even point. At this point, the sales revenues will equal all the costs, and so there is no profit. The calculation starts by determining the fixed costs, followed by calculation of the variable costs. Knowing the sales price, the manager can then calculate sales revenue for units produced. The break-even point occurs where the sales revenue line crosses the line that represents total costs. Sales above this amount will give a profit. If sales do not reach this amount, then a loss is made. We shall look at an example. Morebytes produce modems and routers. The figures for the production of the nibble modem router are shown. The details needed are the selling price, variable costs per unit, and the total of the fixed costs. How do we now determine the break-even point? Remember that at the break-even point there will be no profit. The profit equation is now applied. The zero profit obtained will be found by selling price multiplied by number of units, less variable costs multiplied by number of units, and then less the fixed costs. We have used T to represent the number of units. Working through the calculation, we obtain an answer of 500. Morebytes needs to sell 500 nibbles to reach the break-even point. The 501st unit sold will produce profit. If only 499 are sold, there will be a loss. The margin of safety is the difference between the expected sales and the break-even point. The larger this figure, the safer the business may be. If Morebytes expects sales of 1400 nibbles in June, then what is the margin of safety? Expected sales will be 1400 multiplied by $95, less 500 times $95. This gives us a figure of $85,500 as the margin of safety. You will also obtain the same figure by taking expected and break-even numbers and then multiplying by 95. So 1400 units less 500 units gives 900 units. 900 times 95 gives $85,500. The margin of safety ratio is determined by dividing the margin of safety by the expected sales. Using the figures for Morebyte, we have a figure of $85,500 for the margin of safety, and the expected sales are $133,000. This gives a margin of safety ratio of 0.643. Expressed in another way, sales would have to fall by over 64% before a loss would be made on the nibbles. The contribution margin per unit is the difference between the selling price and the variable costs per unit. The profit equation has already given us that profit is equal to the selling price times units less variable costs times units and then less fixed costs. So profit is the contribution margin per unit times the number of units less all the fixed costs. We can use the information to perform a calculation such as determining the number of units needed to produce a profit target. Suppose Morebytes have set a target of $12,000 for profit. How many units will this represent? The nibbles needed will be determined by profit plus total of fixed costs divided by the contribution margin per unit. The contribution margin per unit is $95 less $42, giving $53. So we can determine that we need to sell 727 nibbles to reach this profit target. We have determined the number of units required to give a particular profit. Remember that the calculation involves taking the profit figure and adding the fixed costs. Then we divide this result by the difference between the selling price and the variable cost per unit. Let us just run through a second example. To achieve a profit of $92,000 in the coming year, then we add $92,000 to fixed costs of $26,500. Then we divide this by $53. This gives us a total of 2,236 nibble units to be sold. The contribution margin ratio is the amount of incremental profit made by each additional dollar of sales. This is given by taking the difference between selling price and variable cost per unit, and then dividing the result by the selling price. We can do this calculation for the nibble. The margin will be the difference between selling price and variable cost per unit, which gives a figure of $53. This is divided by the selling price of $95. The result is a ratio of 0.56 or 56%. Often a business will want to determine the sales in terms of dollars to achieve a profit target. The required sales figure is given by profit targets plus total fixed costs, then dividing the result by the contribution margin ratio. Suppose Morebytes wants nibble sales to produce a profit of $20,000. We take the profit of $20,000 and add $26,500 of fixed costs to give a total of $46,500. Now we divide this by 0.56. The sales required will be $83,000 and $36. Managers find cost-volume analysis useful to look at different scenarios. Suppose that fixed costs are to increase by $4,000. Then how will this affect the amount of profit if 2,500 nibbles are sold in the month? The profit before the change in costs will be $106,000. After the change in fixed costs, then the profit will fall to $102,000. Morebytes produces a second modem router, the Chewit, which has a selling price of $163 and variable cost of $88 per unit. Morebytes sell 3 nibbles for each Chewit sold. We can determine the weighted average contribution per unit. The contribution margins are $53 for each nibble and $75 for each Chewit. The weighted average contribution is the sum of 53 times 3 and 1 times 75. Then this total is divided by 4. This gives us a weighted average contribution per unit of $58.50. Very often a business will have many products or many items that are retailed. In these businesses, the figures of interest may be shown by department. Mountain Life chooses to represent the figures in terms of the range of items being produced, grouping these into tents, shoes, and clothing. For these ranges, the contribution margin and the contribution margin ratio are determined, along with the profit. Figures are also calculated for the totals. Mountain Life can now determine the break-even for sales. The total of fixed costs will be $203,000, and this is divided by the contribution margin ratio of 0.71. A total of $285,916 is required in sales for break-even. This ends our second podcast on cost volume profit analysis, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information about Parkbench Tutors, please visit parkbenchtutors.com.